Imagine a couple named the Harrisons. They did everything the financial magazines told them to do for 35 years, maxed out the 401k, earned the full company match, bought blue chip stocks inside the plan, avoided credit card debt, raised two kids, paid off the mortgage, and when Jim turned 62, they walked into their local branch of one of the biggest banks in America and rolled their combined $824,000 in retirement savings into what the banker called the Conservative Income Fund. That was their nest egg. That was the reward for a lifetime of discipline. Then, on a Tuesday morning in February, Jim opened an envelope from the Social Security Administration and another from the Internal Revenue Service on the same day. Social Security told him his benefit had been reduced because he had too much other income. The IRS told him he owed $14,612 in additional federal tax for the previous year, plus a $412 surcharge on his Medicare Part B premium for triggering an income bracket he never knew existed. The Harrisons didn't lose a dollar to a scam artist. They didn't get tricked by a fake caller. They were drained by the invisible partner that has been sitting on their account since their very first paycheck. The United States Treasury, collecting a toll every single time the money moves. And here is what makes their story a national emergency in 2026. The rules of that toll booth are about to change in ways that almost no retiree is being warned about. The window is closing on the cheapest, cleanest, calmest way to fix this. If you are within 10 years of taking your Social Security check, or if your parents are, what I'm about to walk you through could be the difference between leaving your children a legacy and leaving them a tax bill with your name still on it. Let's slow down and name the actual problem, because the Harrison story is not unusual. It is the default. When you contribute to a traditional 401k or traditional IRA at work, you get a tax deduction that year. The money grows tax deferred. That sounds free, but it is not free. It is a loan, and the lender is the federal government. The IRS owns 25 to 35 cents of every dollar sitting in that account, depending on your future bracket, your state of residence, and whether you live long enough for the money to triple or quadruple before you touch it. So when Jim and Linda Harrison look at their balance of $824,000, the real number they get to spend is not $824,000. It is roughly $575,000 after federal income tax, and that is before state tax, before Medicare surcharges, before the Social Security taxation formula kicks in. Most retirees never do this math. They assume the number on the statement is theirs. It is not. It is a shared account, and the partner who has been silent for 40 years is about to start cashing out. This is the moment in the video where I need you to do something for the algorithm, for me, and for the other retirees in your family who will not seek this information on their own. If this is useful, hit that like button right now. Subscribe to the channel and turn on the bell so you do not miss the next breaking update. And drop a single word in the comments. Bank. Just the word bank. That tells me you understood the metaphor, and it tells YouTube that this video is saving people real money. Now let's get back to the invisible partner. The mechanic that destroyed the Harrisons' February morning is called income stacking, and once you see it, you cannot unsee it. Picture 3 toll booths sitting side by side on a highway. Booth 1 is ordinary federal income tax on your 401k withdrawal. Booth 2 is the Social Security taxation formula, which says that up to 85% of your Social Security check becomes taxable once your provisional income crosses roughly $34,000 for a single filer or $44,000 for a married couple. Booth 3 is IRMAA, the Income-Related Monthly Adjustment Amount, which is a surcharge on your Medicare Part B and Part D premiums that quietly doubles or even triples once your modified adjusted gross income crosses a series of thresholds. Here is the trap. A $40,000 401k withdrawal does not just create a tax bill on $40,000. It pushes your provisional income above the Social Security threshold, which converts thousands of dollars of non-taxable Social Security into taxable income, which pushes your MAGI above the IRMAA cliff, which adds hundreds of dollars a month to your Medicare premiums for the entire following year. One withdrawal, one number, 3 toll booths. That is the domino effect, and it is happening to 1 million retirees a year who thought they were just taking a little extra for the grandkids. Pillar 1 of what I want you to lock in today is the IRS rule that controls how fast you are forced to empty the bucket. These are called required minimum distributions, or RMDs, and they have just been rewritten by Secure Act 2.0 in ways that change the math for millions of households. Before 2023, RMDs started at age 72. Then Secure 2.0 pushed the start age to 73 for people born between 1951 and 1959, and to 75 for anyone born in 1960 or later. The penalty for missing an RMD used to be a 50% excise tax on the amount you forgot to take. Secure 2.0 cut that penalty in half to 25%, and if you fix the mistake within a defined correction window, it drops to 10%. That sounds like relief. It is not. A 25% penalty on a missed $50,000 distribution is still $12,500 vanishing into the air, and the IRS does not send a warning letter first. They just send the bill. The point is not the penalty. The point is that, starting in 2026, more retirees than ever will be crossing into the mandatory withdrawal zone at the same time, and the cascading tax consequences are about to hit a generation that built 7-figure 401k balances during the longest bull market in American history. Pillar 2 is the rule most retirees have never been told about, and it is the one that makes waiting so catastrophically expensive. The IRS calculates your RMD by dividing your prior year-end balance by a life expectancy factor published in Table 3 of the Uniform Lifetime Table. The math feels reasonable on a small balance. On a $900,000 IRA at age 75, your first RMD is roughly $37,000. That income stacks on top of your Social Security, your pension, if you have one, and any dividends from your taxable brokerage account. Suddenly, a retiree who has plenty of money is living in the 24 to 32% federal bracket, paying state tax in 41 states, watching their Medicare premium climb, and paying tax on 85% of their Social Security check. Every year you delay the conversation, the balance compounds, and the required withdrawal gets larger, and the tax bracket you fall into gets harsher. Waiting is not the safe move. Waiting is the most expensive decision you can make because the IRS does not let your balance grow tax-free forever. They force the harvest and they choose the season. Let me give you a tale of 2 retirees to make this concrete, because abstract numbers do not change behavior, but specific people do. Retiree A is named Margaret. She is 72, widowed, lives in a mid-cost state, and has a $700,000 traditional IRA. She does nothing. She wakes up on her 73rd birthday and takes her first RMD of $30,000. That pushes her total income above the Social Security taxation threshold, taxes roughly $18,000 of her $28,000 Social Security check, and adds an IRMAA surcharge of about $1,800 to her Medicare premium the following year. For the next 15 years, she takes RMDs that grow from $30,000 to over $60,000. After accounting for federal tax, state tax, IRMAA, and Social Security taxation, the lifetime tax drag on her account is roughly $310,000. Her heirs then inherit the remaining IRA and must drain it within 10 years under the Secure Act 10-year rule, which I will explain in a moment, adding another 6-figure tax event for her children. Retiree B is named Robert. He is the same age, same state, same $700,000 balance, but in the year before his first RMD, he sits down with a fee-only fiduciary advisor, executes a 3-year partial Roth conversion ladder, and shifts $90,000 a year from the traditional IRA into a Roth IRA. He pays tax on those conversions during a year when his bracket is artificially low because he has not yet started RMDs. By the time he turns 75, his traditional IRA balance is $430,000 instead of $700,000. His lifetime tax drag over 15 years is roughly $170,000 instead of $310,000. $10,000, and his heirs inherit a Roth account that grows tax-free and can be distributed income tax-free during the 10-year window. The difference between Margaret and Robert over a 20-year retirement is roughly $400,000 of real spendable wealth, and Robert's children start their inheritance with a clean balance sheet instead of a 40% tax bill attached to it. Same market, same lifespan assumption, same starting number, two completely different outcomes, decided entirely by what happened in the 18 months before the first RMD check cleared. Before I keep going, hit that subscribe button if you have not already. We are now deep into the part of the video that the planners charge by the hour to explain, and I am giving it to you in plain English at no cost. The like and the subscribe are how this channel survives. So if this is saving you from a future phone call with the IRS, the 30 seconds it takes to do both is the easiest financial move you will make today. Pillar 3 is the change that is making 2026 a fork in the road rather than just another year. Secure. Act 2.0 contains a clause that took effect on January 1st, 2024, but the consequences will hit maximum pain in 2026 and beyond. High earners age 60 and older can now make catch-up contributions to their workplace retirement plan on a Roth basis, meaning no deduction now, but no tax forever, including on the earnings. For someone in their peak earning years who expects to be in a higher bracket in retirement, this is a massive shift. Most people, however, do not work for an employer that offers a Roth 401k, or they simply were never told this option existed. The result is that the people who could benefit the most from the new rule are the least likely to hear about it from their payroll department. The clock on this kind of correction is not literal, but it is real. Every additional year you contribute to the traditional bucket at a high marginal rate is another year's worth of tax you have agreed to pay later at a rate you cannot control. The fourth pillar is the generational impact, and this is where the urgency gets personal. Before Secure Act 1.0 passed in 2019, a non-spouse beneficiary who inherited an IRA could stretch the distributions over their own life expectancy, sometimes taking only the RMD each year and letting the rest grow tax-deferred for decades. That is gone. Now, with very limited exceptions, every non-spouse beneficiary must drain the inherited account within 10 calendar years. If you die at 78 and leave your children a $900,000 traditional IRA, they have until the end of the 10th year to empty it. Most of them will not be smart about the timing. They will wait, then panic in year 8 or 9, then take the entire $900,000 in a single tax year, sometimes in two, and they will push themselves into the highest federal bracket they have ever lived in. A 38-year-old beneficiary who inherits $900,000 in a single year can see roughly $300,000 of that disappear in federal tax alone, plus state tax, plus the loss of any deduction they might have had if they had spread the income across the 10-year window. Your 401k does not become your children's inheritance. It becomes their surprise tax bill. The only way to defuse this bomb is to convert it to a Roth before you die, or to use a charitable remainder trust, or to spend it down strategically during your own lifetime so it is not there at all. The IRS does not give you a grace period. The IRS does not call and ask whether you meant to withdraw. They send a notice, they assess the tax, and they start charging interest and penalties on day 2. Knowing the rule beats accidentally violating the rule by roughly 40 cents on the dollar, which is why everything above matters. Pillar 5 is the action checklist, and I want you to treat this as a homework assignment you can finish today, mostly with a phone call and a pen. Step 1. Find your most recent 401k or IRA statement and write down the exact balance, the exact custodian, and the exact account number. That single number is the lever the rest of this video pulls. Step 2. Pull your last 2 tax returns and look at line 2B, which is your Social Security benefits, and line 4A and 4B, which tell you how much of your Social Security was already taxed. Circle those numbers in red. If they are not 0, the income stacking toll booth is already charging you. Step 3. Call the Social Security Administration at the number on the back of your award letter, not a number from a Google search, and ask them what your full retirement age benefit would be if you delayed to age 67 or age 70. The difference between age 62 and age 70 can be more than $1,000 per month for many retirees, and that decision locks the moment you take the first check. Step 4. Sit down with a fee-only fiduciary advisor, not a commission-based broker, not a banker whose paycheck depends on selling you a product, and ask them to model a partial Roth conversion in the year before your first RMD. A good advisor will run that model in under 15 minutes using software that costs them nothing, and the conversation costs you an hour but could save 6 figures. Step 5. Update your beneficiary forms on every retirement account. Most people have not done this in 15 years, and outdated beneficiary designations are the single most common reason that an IRA ends up in the wrong hands, gets dragged through probate, or is taxed at the highest possible rate. If you have followed this far, you now know more about your 2026 retirement tax exposure than roughly 90% of retirees walking into a bank branch this morning. You know that the IRS owns a hidden share of every traditional 401k dollar. You know that one withdrawal can trigger 3 separate federal toll booths at the same time. You know that Secure Act 2.0 has rewritten the RMD start age and pushed more retirees into the mandatory withdrawal zone in the next 24 months. You know that the 10-year inherited IRA rule can weld a tax bomb directly to your children's future income, and you know that there are 5 concrete steps you can take this week that take a combined total of less than a few hours and could easily be worth 6 figures over the rest of your retirement. The Harrisons never got that information, and they paid for it in February. You are no longer going to be the Harrisons. This is the moment where I am going to ask you one last time, very directly, to do 3 things. First, like the video. It takes one thumb and it tells YouTube that this kind of content protects families. Second, subscribe and turn on the notification bell because the 2026 rule changes are still landing and I will be covering every one of them. Third, leave a comment. Tell me the word Roth. Tell me your age bracket. Tell me the single biggest question you have about your own retirement account. I read the comments, and the most common questions become future videos. The IRS does not send a warning letter. They just send the bill. The only warning you have is the one you give yourself right now, before the December 31st deadline you didn't know existed. Close the tab on this video without acting, and the toll booth stays open. Share this video with the one person in your family who won't look this up on their own, and the toll booth closes for an entire generation.